Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, in today's episode, I want to talk about enjoying the healthy years of life without regret later on. And normally, most of my podcasts are about very practical elements of building wealth, but there's just as important, arguably, psychological aspects of wealth accumulation as well, which I don't spend a lot of time talking about, and maybe I should. But what I want to talk about today is that, for decades, often decades, we are conditioned to work hard, save hard, invest hard, and just keep building wealth. I don't mean that to the extreme. Of course, there's plenty of people out there listening to this podcast that enjoy some niceties along the way as well. I mean, most people listening to this podcast are of a mind to, want to sacrifice today so that they can enjoy a better tomorrow. But for those of you that are already on track to be financially secure or are already financially secure, the question really isn't how to accumulate more wealth. It's, avoiding the years, wasting the years when wealth is most valuable. So really knowing when to ease back work and how to do that safely could be, one of the more important decisions that we really make in our lifetime. Now, as I said, I normally write about and talk about practical elements. And that's what a lot of financial commentary out there is about, focusing on financial failure and how to avoid it, poor investment returns, running out of money in retirement, covering aged care costs, fighting the impact of inflation, all these sorts of things. Now, they're all very important issues. And for most Australians, I think they deserve to be, of course, high on the list. But as I said, for those who are already in a strong financial position, or likely to be in that position by the time they retire, different risk emerges. There's underspending in those early years of retirement when health, energy, and freedom are really still on their side. And for many people, the real fear is not running out of money, it's looking back with regret. And I certainly share that. No, I don't think I will because I heed my own advice. But the last thing I would want to do personally is be in a situation in my 80s where, I don't have the ability anymore to travel as much or enjoy the different things that I enjoy today and have too much money in the bank. I mean, I'd love to leave some to my kids, of course, charities and so forth. So in addition to that, what happens if I have surplus money in addition to that? Because in retirement, wealth could still be abundant, but energy might not be, at least not in, for the entire retirement phase. And then that's why I like to think about retirement in really two phases. The first phase, let's call it the high health phase. That might cover the first 10 to 15, hopefully 20 years of retirement after we finish work. And they're the years where we're going to be more mobile, social, adventurous, capable of, enjoying different travel experiences, greater freedom, all those sorts of things. And then the second phase of retirement, the lower health phase, maybe during this phase, typically spending declines because, there's our priority shift and maybe we don't have as much health and mobility and energy to do the things that we used to do. And perhaps maybe more of our money is going to be spent on conveyances, support or care, these sorts of things. And so I think the holy grail for most people is really knowing how much can they safely spend in that first phase of retirement without compromising the second phase of retirement, without putting yourself in a situation in that second phase where you need to worry about money, where that if you have higher levels of care or you need to go in a home or do something like that or have medical issues, you don't need to worry about money in that stage of life. But how much can we spend in that first phase so that we don't compromise that second phase? Now, this requires a pretty significant mind shift because for decades while we're working, we're really conditioned on accumulation. As I said at the beginning, work hard, save hard, invest hard, reduce debt, make long-term investment decisions, let compounding do all the heavy lifting, all that sort of stuff. Speaking about it like it's boring stuff, it's not boring stuff, it's very important stuff. But, for many years, that's what we're sort of feeding our brain. That's what we're focusing on. That's what the decisions we're making. But in retirement, and particularly if the plan involves, drawing down wealth to enjoy that high health phase of retirement, then the mind shift needs to shift from accumulation to decumulation. Which, as I said, is a pretty significant kind of psychological shift. In the years of building wealth, it's about investing more. In retirement, it sort of shifts on how we're going to use that wealth. So, really, it requires a different kind of set of tools, if you like, forecasting, future spending, thinking carefully about lifestyle goals, and working out how to draw assets in a sustainable way. So, spending capital, you really need to manage things very well. You need to manage sequencing risk, there's taxation elements, maintaining enough liquidity within your portfolio to fund your lifestyle goals. But whilst at the same time, not being too conservative that, you're underperforming in terms of investments. But let's face it, spending capital is kind of the reason we accumulate it. And sometimes I think we work so hard that we think we shouldn't ever spend capital, that we should continue to protect it and do whatever we need to protect it. And I've spoken previously about a perpetual portfolio, which means that despite your spending, your wealth accumulates. And that sounds good mathematically. And, I like the idea of it as well. But we need to question whether that is really what we're after and at what cost does that come to us? What are we foregoing by aiming for a perpetual portfolio? Because what's the whole point of working hard and investing, sacrificing, delayed gratification, all these sorts of things, if we can't actually enjoy or reap the benefits of all that hard work eventually in the long run? And so I think that's part of the puzzle, is acknowledging that there are phases of wealth accumulation and phases of entering into retirement. And if we pre-position that in our own mind right from the outset, or at least during our journey, before we get there, that might make that psychological transition from accumulation to decumulation a little bit easier. Now, remember, it doesn't mean dying with zero. There's that book, Die with Zero, which means really run your portfolio down to zero while leave any money. For some people, it's about security too, making sure, if you die with $1 million in the bank, well, that's not really a missed opportunity because, you like having $1 million in the bank because it gave you financial security. Also, some people, they would like to leave money to charity or to beneficiaries, children, these sorts of things. So it's not about ignoring those things and not doing those things, but it's really making sure that, okay, after I leave some money to beneficiaries, after I give to charity, after I do the things I want to do, have the buffer in place, let's make sure that there's no wealth in addition to that, or at least not at the cost of foregoing opportunities I would otherwise have liked to pursued. And for some people, that's going to mean, to some extent, decumulation. And that's okay. It's not a failure of the plan. It is the plan. And I think that's really important. Now, of course, we don't want more financial stress in retirement. So I think that would be probably one of the common, concerns of people thinking about running down assets, decumulating assets, is that, I don't want to risk being in a situation where I do that too aggressively, too early on, and then put myself at risk and cause myself, stress, financial stress, because I guess once we're retired, we're going to be loath to go back to work because we've messed it up, and in some situations that's not even possible. So we want to be really careful about that. And I think that's where we need to understand that financial planning and planning around these things isn't really about planning around a finite number. What is the exact maximum amount you can spend? It's really around probabilities, ranges, putting sensible guardrails in place rather than, trying to pinpoint what is that exact number, as I said. And a practical way then to think about your investment assets is to really divide them into 3 categories. So what is the minimum capital you need for a comfortable lifestyle throughout the rest of your lifetime? So they're your core assets. They need to be protected, invested in a way that are going to, generate good quality returns over long term, using the same evidence-based strategies I talk about. The second category is then really, let's call it contingency capital. That's really the money we might set aside for any uncertainty. So things like poor market conditions, so we don't have to sell any assets if there's volatility, health issues, future aged care costs, these sorts of things. And then the third category is what's left over. It's the capital left over. Let's call it discretionary capital. So that really can be used more freely, whether it's enjoying the high health phase or helping family, making donations. Because again, what's the point of, you dying with $10 million in your bank account at age 90 when, if you're of the mind to, you could have given it to your children 30 years sooner or 20 years sooner, whatever it might be, when they really needed the money or would have helped them to a greater extent. But thinking about wealth in kind of those three categories helps us make those decisions more confidently. And remember, it's about thinking in ranges rather than specifics. So we want to think about, what is the broad range I need for that first category, which is really protecting my lifestyle, then a category for protecting against uncertainty, and then what's left over after that. One of the challenges that some people are going to have with this transition or applying this approach is if they're asset rich but income poor. Some people are going to be in a situation where they've got a lot of their wealth that are tied up in direct property, unlisted investments, businesses, these sorts of things. On paper, they might look very wealthy, but in reality, from a cash flow income perspective, they may not be in a position where they're able to necessarily go and spend a lot more. So this is really a case of better planning, I think. Better long-term planning, and there's a basis then for maybe tilting towards more liquid assets over time. And hopefully you can sort of build that into your plan as well as trying to make sure or to think about, liquidity and how important it is. Again, particularly if you want to sort of enjoy that high health phase. So it's not really, how much wealth you've got, but it's where you hold that wealth that really matters. And this is a psychological transition as well, because during our working lives, we think, buy high quality property, hold it for long term, let the compounding capital growth do all the heavy lifting and never sell. Let that capital growth just keep compounding. And that's a really good strategy through the accumulation phase. But the decumulation phase, we need a different kind of mindset, that selling a property might feel like a failure, the wrong thing to do. But selling could be, in fact, the opposite. I mean, the reason we choose property when we're younger is it's highly effective to build wealth with gearing and compounding capital growth. It does all the heavy lifting, but the reason we might sell property in retirement is because it's already done its job. It's helped us build wealth. It's helped us get from step A to B. And so now if liquidity is preventing us from achieving our lifestyle goals, from, enjoying the fruits of our labor, then of course we need to make those changes. It's certainly not a failure. It's in fact why we financially plan out these sorts of decisions. I see it a lot in business as well. People that work hard, being self-employed for a large portion of their life, and they have a lot of equity tied up in this business. And the whole idea is let's try and release some of this equity eventually so that it can supplement, the rest of our asset base to, enjoy retirement and enjoy those high health years. But, it can be challenging. Again, succession planning, I think, it's a little bit beyond the scope. It's something we talk about in Holistic Accountant podcast. But, succession planning for business owners is something that I think most business owners leave way, way too late, and it doesn't make any sense. So apart from the wrong mix of assets to, be able to enjoy that high health phase, there's a couple of other mistakes that investors can make, and which means I put it in the basket of kind of being too defensive, I guess. That's the way we could explain it. And that can show up in a couple of different ways. So delaying retirement is one of those ways, working that extra couple of years just because it feels safer, even though it's not really going to move the dial in terms of put yourself in a situation, put their self in a situation that, makes them a lot more financially stable. If they're already financially stable, working another couple of years isn't going to give them, any more safety. Other times it can be continue to be quite conservative with spending in retirement. Now that might sound like an odd thing for me to say as a financial advisor. And it's not my job to judge what are people spending and whether they're spending enough. It's their life. Don't go and spend money if you're not going to get any utility, any satisfaction from it. But we've got to acknowledge there is a psychological shift from saving, investing to spending and enjoying that wealth. And that psychological shift isn't always easy, particularly if we've been really disciplined through that period of accumulation. And sometimes it can be just really giving ourselves the permission to actually spend some of that wealth, to either give it or spend it on experience or give it to family members or donate it to charity, whatever is going to give us that utility or satisfaction. But it's about giving ourselves the ability to do that. And I think that's why, even through the accumulation phase, making sure we do as a priority invest and save for the future, because you need to do that obviously regularly with discipline to be successful. But also, making sure we do have a little bit of money along the way to enjoy, or hopefully even a lot of money if we can afford it, along the way to enjoy the process, because building wealth's not really a destination, it's a process. And, we don't know how long we're going to be on this earth for, so we may as well enjoy the journey as much as we possibly can throughout that accumulation process. And the final example of being sort of too defensive is, as I said, around really relates to self-employed people. As I said, around businesses, lack of succession planning, having too much equity tied up in a business, not then being able to use that towards or contribute towards using that in retirement. Yeah, that's certainly one issue. And that's really just a lack of succession planning, which, as I said, I think business owners, the benefit of starting succession too early is that you can move at the pace that is right for the plan. The problem with leaving succession too late, so you think 5 years in advance, okay, 5 years I need to sell this business. All of a sudden you're making decisions that are dictated by your timeline rather than what is best for the business, what is best for you, what is best for your family, what is best for the people inside the business. So that succession, that's different to the other defensive thing that occurs where you're trying to extract too much money from the business, which means maximize its sale price. Now, I know that sounds silly because, of course, if we spent decades or years in our business building it, of course, we don't want to just give it away. But the cost of, just trying to extract that last 20% of value could mean that, I end up spending another 20 years in this business and forego that 2-decade period where I could have been doing something else with my time. And look, the answer is here, particularly for business people, it's not a black or white decision. There's some nuance here, and you can probably do both. You can have a well laid out succession plan that allows you to withdraw equity from the business and invest it in a way that's separate from the business, whilst also having a more balanced approach now. Because you've got an asset pool already to fall back upon, you're less reliant then to extract every single dollar from the business from a value perspective. But there is more complexity, I think, or more common mistakes with self-employed people. Now, of course, your estate plan, as I mentioned a couple of times today, your estate plan will guide some of your decision making around this. So, you need to think about, how much you would like to leave to your beneficiaries. What does that look like? I mean, sometimes, for some people, their viewpoint is leaving too much is not so great either. I think Warren Buffett said, I want to leave my kids enough money to do anything, but not so much money that they do nothing. So there's that, of course. But the thing is that, if you don't think about these sorts of things, chances are you will underspend during retirement, because you're always of a mind to think, well, I want to leave something to my kids, but you don't ever quantify that. And then you don't ever sort of start quarantining that sort of portion of your wealth for that purpose. And so what happens typically then, people underspend, and they end up leaving more wealth than they expected to their children, which, I mean, I'm not saying that's a terrible outcome, because, some people are very happy with that. It's not for me to judge. But what you don't want to do, as I said, I don't want to be, for instance, personally, I don't want to be in my 80s looking back and thinking, well, I should have spent more in my 60s and 70s or whatever, whenever I was healthy and able to do so, because my kids are always going to be fine. They're going to have enough money. They're probably going to have more money than they expected. And I could have enjoyed that money, 20 years ago or whatever it might have been. So really then the best way to deal with that is to take a 3-step approach. The first thing is to think about, well, what do I want to spend? And again, think about your retirement as 2 phases, high health phase and a lower health phase. And so you might say, well, the high health phase, I'm going to spend $200,000 a year, and the lower health phase, I'm going to go down to spending $100,000 a year. I don't know what the numbers are. I'm just giving you an idea, or an example, I should say. And it probably makes sense that in your 80s, for instance, you're not going to spend as much as you will in your 60s and maybe even 70s and so forth. So I think you've got to make an adjustment there. The next thing you need to do is then work out, okay, then what pool of assets do I need to fund that income profile, if you like? And you've got to be conservative about investment returns. And what you need to look at is an investment return net of inflation. So what I mean by that is I say, well, if I'm going to go for 7% returns, that's my long-term assumption. I think that's right. I think 7% is kind of a good number. 10% is what you're going to get from the share market. Maybe you're going to not have everything in the share market, so we'll back that off a little bit. And because volatility and sequencing risk and all these sorts of things that we can't really plan around, I think 7% is kind of a good conservative assumption. If we then assume inflation is 3%, then really our return, excluding inflation, is really 4%. And that's what we need we can then use a present value formula in Excel or do a spreadsheet or ask ChatGPT or one of the other models to tell us then, how much money do I need today to pay me $200,000 for 20 years and then $100,000 for the subsequent 20 years. So we're looking at a 40-year period. And we can then work out, what sort of capital that looks like or what sort of capital we need in order to deliver that outcome. And then, of course, we can compare that to our asset base today and we can then decide, can we retire sooner? Is retiring now, in fact, a doable thing? And you might not even retire now. Just knowing that you can retire might give you more satisfaction because each day when you go to work, well, I don't have to do this if I don't want to. And so if you're not getting the satisfaction, the non-financial satisfaction from doing that work, well, then you can make a different decision. But if you are getting that non-financial satisfaction, and if that was to change down the track, well, again, you can change your decision. So I think it's more about knowing you've got choices more than anything else. So then if I work out I need $3 million to, enjoy the sort of standard living that I'd really want over my retirement. And then if I say, okay, I've got 2 kids, I want to give them $1 million each in today's money. Okay, well, that's $5 million. And then if I look at my asset base and say, well, I've got $7 million of investment assets, then I can conclude that I've got around about $2 million that I could potentially spend during that high health phase of retirement, whether that's giving away to charity, whether it's spending on experiences, but at least I know it's there and I can still provide for what I really wanted to provide for to my beneficiaries. But if I don't think about that number, what's the minimum number I'm happy to leave to my children? You need to think about that now. Often a lot of people don't think about it. And so if you don't have that target, you can't really plan for it. And then people then think, oh, well, I don't want to spend too much because it was important to me to leave something to the kids. And as I said, if you don't do that, you're going to underspend. Look, the thing is all about financial modeling. It's all about conservative assumptions. So financial modeling is only as good as the assumptions used or inputted into it. And these are really important decisions. So, some people are going to be in a situation where they're quite confident doing those numbers, and that's great. But if you aren't confident and they're really, because they are important decisions, you don't want to get to a situation where you spend too much, of course, and of course underspend. Maybe it's a situation where you need some professional advice. And if it's just the numbers bit, maybe an accountant can do that for you rather than specific financial advice. If you just want to model something, you might not need financial advice per se. The important point I wanted to make today is the accumulation phase is really important. And I talk a lot about the strategies and approaches and considerations that will help make that phase more economical. And that's really important. But the decumulation phase is just as important, I think. And thinking about some of these things, thinking about what does retirement look like? In that high health phase, what would I like to do? What are the things that have been on my bucket list? What sort of adventures do I want to go on? And then also, what do I want to leave behind? To what extent do I want to help kids or other beneficiaries or charities or these sorts of things? And that just helps you plan. And done well, it means that the chances of having regret later on in life are much, much lower than if you don't think about these things. Now, of course, it doesn't just mean, oh, well, I might retire suddenly tomorrow. I mean, just knowing you can retire, as I said, gives you that a little bit more of that sort of psychological freedom about it. But for many people, it's more nuanced than that. It might be, different type of work, maybe lower paid work, but work that you really connect with. It could be stepping away from new responsibilities. So, instead of going for that promotion, you want to stay at that level because it gives you a little bit more work-life balance. Or it could be, gradually easing into retirement. For others, it's progressively selling down a business, implementing a succession plan and reinvesting in other assets. And for those that are already retired that, are sitting on surplus financial assets, It could be making the most of their freedom that they've earned. It's going to be different for every person that's listening to this, but I guess the risk is we don't want to look back and think we worked too long, that we should have retired 5 years early or 2 years early. You hear those stories sometimes of the person that retires and unfortunately then they pass away relatively quickly after retirement. They didn't get to enjoy that period of time or that stage of life. And similarly, like I said myself, I don't want to look back in my 80s and think, well, my bank balance is huge, but I wish I had spent a little bit more or did a bit more travel in my 60s or 50s or whatever it might be. And I think planning and decumulation, that phase and planning around it, I think is just as important as the accumulation. And, I get I get a lot of a kick actually out of working with a client and seeing them enter into that decumulation phase and seeing the enjoyment and satisfaction that they get from doing that, from enjoying the fruits of their labor, all their hard work. But it is a really important financial planning step because, again, we want to give our clients that freedom to make those choices, but make sure that they don't go too aggressive, spend too aggressively, that then creates problems later on in life where they don't have as much financial security as they wanted. So it's a tight balance, but I think the key thing here is it's a psychological shift and we need to know it's coming. And I think if we tell ourselves it's coming, that there's a accumulation phase and a decumulation phase, and they're both going to require different mindsets and different approaches, but planning around both phases is just as important. Okay, I'm going to leave it there today. I hope you enjoyed today's episode. Next week, I'm going to talk about lump sum share market investing. So that's something I've shifted my view on. Anyway, I'm going to give you the evidence, all the evidence that behind it and the approaches that you can think about utilizing. And it might sort of test your intuition on it, actually. So anyway, that's next week. Until then, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.